CMBS had $148 billion of maturities coming due in the fourth quarter. 80% of all of those loans outstanding in the fourth quarter had a coupon of 5% or less. So just by simple logic that they were all cash in refis. So you can extend all day long. You can't pretend there's no cash flow. What's happening now is that the extensions are occurring because the lenders don't know if there's a market to sell into. And what they're doing is they're just increasing the maturity wall higher and higher and higher. Now, the problem is that the exits today for people to get a refinance are very small because the balance sheets are back open, but they don't want more Class B office or C multi.
Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill by Mel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. I am very fortunate today to have a special guest. It is not easy to find folks with the level of experience in debt resolution that I often am saying we need more of. And so, Michael Cohen, welcome to the Debt Doctor.
Thank you. Thanks for having me.
Michael, you are the founding managing partner of Lien Capital Advisors. This is a commercial real estate advisory firm specializing in the representation of borrowers and their attorneys in CMBS and CLO servicing workouts. You are a pioneer in the business of CMBS. You're going to get into all that with us. And you've worked across the full securitization lifestyle, including underwriting, origination, ratings, and distribution. One of the most interesting things I find about CMBS is one thing when you're buying private debt, which I've done now for almost 20 years, or it's necessarily bank debt that now is in the hands of private. It's a whole different game than being under the trenches of a securitization or a servicing certain handcuffs of servicing. Talk to me about, give us your backgrounds, tell us a little bit about where you sit in the market.
Yeah, thanks for having me. I'm really happy to share this information. I try to express what's happening in real time because we're working with all the servicers and master servicers. My background started out in the after business school in the early 90s, actually working out loans and limited partnerships and kind of things like that. And it led me into an assignment to go to Lehman Brothers to help them package RTC loans for securitization. And then I kind of, the light bulb went out and said, wait a second. Securitization works to really, this is what the markets need. I was one of the founding partners at DLJ, which started Collin Financial, and that was when God was a baby back in the early 90s. I came out and left with a number of the senior management to move down to Charlotte, North Carolina from New York City. I'm an upstate Rochester, New York boy to begin with. That's why it's called Lien Capital, my hometown. And we went to Charlotte, North Carolina. And I'm like, where's that? And I went, loved it, still there for 28 years. And that's where we're headquartered.
Banking sector of the South.
Banking center of the world, great people, great lifestyle. when I started this business, I was an underwriter. I went through all the phases. We securitized the first when we securitized the first deals. We're getting curly Q faxes. We closed all the loans at one time. I walked across the street from the cage. I mean, it put the comfort letter together. I mean, but I realized that I'm pretty good at communicating with borrowers and understanding their plight because I really do appreciate that. And honestly, I started this business in 2020 because I knew that CMBS was going to have a severe correction, that the market can't be that closed for that long with such a categoric shift by having COVID, that the loan docs in CMBS are rigid and they're based on the time when you close the loan and the information. So all of this was going to need reckoning, and we're going to have to fix these one by one. I started out my career after moving to Charlotte. I was really the head of the Southeast and the Mid Atlantic for the balance of that time, working with borrowers in all phases, either the good phase where it was like, hey, great interest rates, to all the cycles of 2003, 1998. I really came out in 2012. I joined UBS at the time, and I started getting people out of bankruptcies. I started getting people out of trouble because I could really understand it. I would say of my career of really being a CMBS lender, is the 3 years during the Great Recession of working for an owner operator. I really started to understand what the borrower is going through, and then really understood the communication gap that's going on between the lender and the borrower. So when I formed this business, I really wanted to help the borrower through navigating CMBS special servicing and servicing, because honestly, it takes a village of really smart people, which I surround myself with, to navigate not only the master to the special servicer, but to the controlling class holder, which we'll get into a little bit later, as well as the REMIC rules, which are the trust tax rules, and the rating agency rules. So there's a lot of rules involved, and there's a lot of things that they don't make common sense, and you're going to have to be aware of.
That's
Hopefully that was a pretty good overview of
That's
what
so
I
well
do.
said, and I mean, listen, I've been screaming from the rafters. I started First Lien around 2020 as well. We bought our first deal in the spring of 21. And, I saw a reckoning coming before even the pandemic.
Yeah.
You knew that. And then when you knew that the ZERP and the eventual end of it would then cause a whole revaluation of the system too.
Yeah.
And that,
Yes.
that's just an obvious thing that hasn't, the market's afraid to really price discover in many cases.
Yeah, I think price discovery is going to be becoming more relevant in 2026 because we're going to stabilize at what the coupon is. And then once the coupon's determined, we'll figure out what the cap rate is. And then once you figure out the cap rate, my firm is comprised of myself. It is comprised of Richard Fischel, who is a former external counsel in CMBS, and then an internal closer in the conduit for Bank of America. And then he went over to large loan special servicing and did all the workouts during the Great Recession, for when it was Merrill Lynch and Bank of America combined. They have a servicing group, and then he went externally again. So he doesn't practice, but knowing the legal ease and having a lawyer at your fingertip is amazing, and he's brilliant. He's a former geologist.
And he's your partner in Brighton.
He's my partner. And then my other. I'm the sole owner, but he's my partner. The other person is Tina McNeil, and she spent 20 years in CMBS special servicing at Wells Fargo. So when I started this business, I really didn't know what I was going to do. It was October of 2020. I knew this is going to need fixing. And I started reaching out to my borrowers, and they said, hey, I'm not sure what I'm going to do. And they said, are you kidding me? You're going to help me. And so I realized that I had to build an inverse conduit because I had to be able to have the resources I need in order to navigate and create loan workout situations, but understand the other side so well that when we're negotiating and I'm bringing the lawyer to the table with the borrower, that the special servicer now is like, okay, I got Mike Tyson on the other side here.
That's
Like I
right.
can't screw around.
That's right.
I cannot just railroad you. And yeah, so that's how we
Well,
started.
I'm sure that your clients, as that are borrowers, are praying, thanking God every day that they have you as their representation. Yeah,
Bill, I'm very. Everybody on my platform is very like this. We want to actually make this work, and it's
me too.
stacked against them. I will say, we watch Trap every day. We know it. I could see it. I'm like a doctor. I could see, like you. I mean, I could look into Trap and in 5 minutes tell you exactly what's going on with your loan. We have a lot of borrowers that I'm witnessing that are taking the approach of either I'm just going to wait and get into special servicing and I'm going to combat then and I'm going to do anything I can to get into special servicing and I'm going to fight the fight and I'm going to win. That's a fallacy in 2.0. In CMBS 1.0, you wanted to do that, you got to maybe get a discount. In 2.0, it's a whole different ball game and you will get your butt kicked.
Wow.
Or you will get something, you'll get a resolution, but it will not be optimal because honestly, you don't have the 25 to 30-year experience that we do to show you exactly what it is. Second is we find borrowers that are kind of have their heads in the sand and say, maybe the servicer will forget about us, or maybe
Right.
the rates will come down to 3%, or maybe the government's going to throw a bunch of money at us because us poor real estate people are really taking it on the chin. It wasn't our fault. Not going to happen. Non-action is an action, right? So it is extremely important for one to have really good counsel to help protect any of the piercing of the recourse carve-outs. That is number one. We work with lawyers to give us that strategy to tell us how strong or how weak we can go in.
Interesting. Yeah, that's very good. And let's unpack a little of that.
Okay.
And I want to I want to step back to something you said very quickly, which was, brilliant. And I picked up, but for the layman's out there that still don't understand what has happened with commercial real estate.
Mm-hmm.
You talked about, oh, we got to wait for the coupon to settle and then we'll figure out what the cap rate is.
Yeah.
And and because I'm constantly trying to explain this to people, like if you had a 1.2 debt service coverage ratio with a 3% loan, if it goes to 6, you're underwater.
Yeah.
It's simple math.
Yeah.
And because interest rates rose, now the expectation of new buyers into the market has risen in terms of the cap that they need to get to to leverage what the expectations of the market are or to use leverage. So that means that when cap rates increase, prices decrease. So you're
Correct.
getting squeezed from all the way. Can you just kind of give
So yeah, let's talk about that. Let's talk about the bigger picture here. Let's talk about the phases that we're in.
Mhm.
And I was about to mention, I speak on a lot of panels. I also speak in front of a lot of law firms. It's amazing. Major all law firms across the country. They understand it. Nobody really understands the real depths of CMBS securitization. And one of the panels I was on for one of the major firms, they actually did a good presentation. They brought in one of the economists from one of the banks. And the economist said, and this is going to set the table for where I'm going, said Class A across the board assets have really kind of plateaued and they're on the rise and they're starting to do great. And we're seeing that. New York City, for example, you're just seeing prices increase. You're seeing space being for Class A. Well,
Mhm.
Class B is now plateauing. We're coming to the plateau where that means that Class B assets should be settling pretty much where prices are. There's not a lot to juxtaposition more. I mean, who knows, right? The world can crack open at any time. But the thought. But what the most interesting thing he said is distress always follows Class B settling. So when people ask me what inning we're in or where we are, I'm telling you that everybody just finished the pregame stretch and the players are now running onto the field. So
Early
buckle in for
stage.
26. Buckle in for 26. And I'll explain this for a second. So if you look at the phases where we are right now after COVID, post COVID, our lifestyles changed and valuations changed, and we really saw certain asset classes like office where they became obsolete and won't be able to use, and then we saw other asset classes like multifamily, which are necessary but they're over levered.
Mm-hmm.
So the first phase of this correction was really a value change, and really negative value changes for multis, for office, um, certain areas of hotels, but on the flip side, self storage, industrial, and anchored retail start to really rise, and so there's kind of a balancing act here. Where we're going to go next is the transfer of assets, because you have to make a decision as a borrower whether you want to hang on to your property or not. And we're all emotionally, we're all proud of what we do, but it's an asset and you monetized it and you made a loan and you got the money. And especially if you went into CMBS, it is a pawn shop. And so, you're trying to go in there and tell them that you're a good guy, and you have
They don't
zero
care.
relationship with these people, because honestly, you don't have a relationship with them. So you better understand, when working like a bank relationship where you may or balance sheet where you have other loans and other business where you can kind of lean into them. This is not. This is a place where you have to be offensively working on proactively curing your issue, and simultaneously you have to be defensively posturing yourself in case there's a piercing of the recourse carve outs where you can get personally sued or they could take your property back. So just further, one step further. So one of the things, honest, so just to everybody, the way that you look at cap rates, a cap rate for the property, right, which is going to be the NOI divided into the sales price, or by the sales price, is cannot be lower than the coupon you're paying on your mortgage, because if so, whatever you're getting an 8% return and having to pay 9% to the bank, you're working for negative for
Negative
negative.
leverage. Yep.
So if the interest rates, what we're seeing now, it's interesting. Every time the Fed, so far, when the Fed moved the last time and lowered interest rates by a quarter, while the market got nervous about inflation and the 10-year went up.
That's
So
right.
you're seeing there's no magic cure here. So eventually we're going to get to this equilibrium where the coupons are the coupons, and that's why you're going to start to say, okay, well, the cap rates can't be below. That's why I'm saying you're going to start to
That's right.
feel better about trades.
Got it. That makes sense. Yeah, and I've been saying, uh, as people still want to hang on to the fallacy that interest rates that normal is lower, no,
No,
or that somehow we'll go back to a ZERP or something like that. It's just, or that even that it's as simple as making a move at the Fed and having that come to. I just have been saying it. I mean, listen, we're seeing mortgage rates are not directly correlating. There's a lot of other factors. And as
there's one thing that if you look at the rating agencies and they test, there's actually Fitch is one of the rating agencies that rates the bonds. And they have, and you always hear about it when it's a low interest rate environment. It's called the Fitch debt service coverage ratio test, because Fitch makes the assumption that the average coupon, and I'm going to make these numbers up, is around 5.5% on a 30-year AM, and your constant is that constant. So when you got your 3% at a 120 debt service coverage, it didn't compute with Fitch. They're like, well, we're not going to give you credit for that because you're going to come to a refinance risk, and that's going to be and that's what that's about.
interesting. And that's really, I think that's where all the stress and heartache is really sitting right now. I believe we've got
100%.
a large amount of mature. Now, there has been this talk of the every year, the last 2 years since interest rates started going up, of debt maturity walls. I mean, that's what commercial faces is 5-7 year
Hmm.
maturity. The entire market turns over. Uh, why hasn't the maturity wall? And I think I know the answer now that I've heard about the Class A and the Class B and everything like
Well,
that. But
I'll give you some stats here. So in the fourth quarter of 2025, CMBS had $148 billion of maturities coming due in the fourth quarter.
Mhm.
80% of all of those loans outstanding in the fourth quarter had a coupon of 5% or less. So just by simple logic that they were all cash in refis.
Mhm.
So you can extend all day long. You can't pretend there's no cash flow. And I'll talk about CMBS in particular, how it's different than a balance sheet. But
Yes.
what's happening now is that the extensions are occurring because the lenders don't know if there's a market to sell into. And what they're doing is they're just increasing the maturity wall higher and higher and higher. Now the problem is that the exits today for people to get a refinance are very small because the balance sheets are back open, but they don't want more Class B office or C multi, right? The conduit shops are open and they're doing $800 million pools, but that's four major contributors, each putting in $200 million. So why is that important? Because if the maximum amount of, say, office is 20% in your portfolio that you can contribute, and you're contributing 200 million, that means that institution contributing can only put in a $40 million office deal, and that's their quota.
Hmm.
So and then if you look at the metrics, Credit IQ does a great job, and they put it on LinkedIn all the time, and I'm on LinkedIn all the time posting market information. You look at those metrics that they're closing at, they're all 10 to 12% debt yield, which is the NOI divided by the loan amount, which is
Mhm.
very high for good stabilized product. The LTVs are 55 to 60%. They're typically interest only, but you're also getting a six, I would say 6.5% coupon. So hard, and you have to be a clean borrower. So without any issues on your other deals.
Mhm.
So what we find is that when we're able to go in to speak on your current CMBS loans, that we can fix a lot of problems. And we have loans that we're working on one right now in the suburbs of Chicago that they have an issue. They have an obsolete building that's crossed with it. We're getting that able to to sell that early, to restructure the loan, to give the borrower more opportunity to work the asset in a better performance so that it can refinance in 2 to 3 years from today.
Let's unpack some of these specifics because we spoke earlier of the scenarios with the borrowers that you've come in contact. Some are just waiting for special servicing. That may have worked first time around. You're suggesting not. I'm assuming you're suggesting get on top of it
If
right
you're
away.
not in at least 6, we suggest 9 months early before your maturity. If you're not in within 6, you're getting close to the edge because it's going to take us time to get this package ready, and it's going to take time to serve it. And these special servicers are having an all-time high of transfers into special servicing, and more importantly, the special servicers are fee hungry, and they have every right to start collecting fees. And once you get into special servicing, the reason I said that before is you start to lose your ability to fix your problem, and you become under their direction, and you then start to face their fees, their servicing fees, and their legal fees,
Then it's
and
just a
it will
snowball
crush you.
effect. If you couldn't figure it out without that, how are you going to figure it out once those fees and costs
Correct.
start?
You're just so we get caught when we get a call with somebody who said, "Oh my God, now I'm in special servicing and help me." At some points I get involved in just trying to bring back people to the table. You're not. There's no shortcuts here.
Right.
You really have to, and we'll get into that, but you
And
really
just
have to be prepared.
special servicing is when something triggers in the loan. You either stop paying the loan or there's some other, you're coming up on maturity and or you're just
Yeah.
that, and that's then the who are the major special servicers out there?
Yeah.
Are
Well,
you having better luck with certain ones versus
we're
others?
not lucky. We're good. We are we are because I have this team of people that came directly out of these top tier institutions. My last stop was Citi. So you got a Citi, a Wells, and a Bank of America, former employees. We know everybody, but we also know their roles. And let me step back, because one of the things I want everybody to understand, the picture of CMBS.
Mm-hmm.
When you made the loan from your bank, or whoever the lender was, they sold your loan into these bonds. So we're in a situation where you have a master servicer, and that's who's really doing your administrative work. And then you have a special servicer, and they're the ones that are doing, if it becomes a problem and they have to make a change. Now the special servicer then gets their approval from the controlling class holder, and that's the whoever's holding the lowest level of the bond at that time.
Lowest level, and that meaning is that so that would be the last one on the totem pole, or the first one, and is what you're saying, the lowest.
So the last person in line. So the way that the bonds work is you have the lowest levels of the bond, and then you have they're the last ones to get paid in the waterfall.
Right. And they're the ones that you have to seek approval from as the special
We
service.
don't, the
Or the
special
special
servicer
service.
does.
Right, right.
So I always say to everybody, I can see into about 85% of the special servicing process.
Mm-hmm.
I can't see in that dark corner. Now, they're playing games along the way. You're just a puppet. You're just a pawn in their game here, because it's something called bond warfare, where the lowest level, whoever owns the lowest level of the bonds, buys up a number of levels and then
Mm-hmm.
submits losses and wipes out everybody until they're in control again.
Wow.
This is not a straightforward game. So that's why I'm saying it's people who go in and like, well, this doesn't make sense. Of course it doesn't make sense, because they're not thinking of you or the property. They're thinking of themselves and how much money they can make.
Right. And it's almost like there's warring factions within the investment
Correct.
itself. That
Game of Thrones.
Yeah, that makes sense. And going back to what you were saying, why to get ahead of this is special servicers are not incentivized to really.
There's nobody going to answer you. There's a stack of loans coming in every day, and you think that because you need an answer today. We get invited to a number of servicer conferences, kind of like to go in to hear what we've got going on in the background.
Mm-hmm.
And we are able to listen to the servicers, and they're complaining of like, why aren't these people coming to us sooner? So it's a situation where you really have to understand what you're facing to get it. For the
Seems
most
like a
part,
good time to be in the special servicing business. Have you ever thought about flipping to the other side, or?
that's too late. If you think about it, well, I mean, there was a lot of investors that invested during COVID into the special servicing, knowing, and I'll tell you why. When I mentioned that you go to your bank and you get, or wherever your lender was, and you get that, and they sell it into this bond. So now they sell the servicing rights. Well, two things you didn't know after your closing dinner of how happy you were to get this non-recourse loan. One was you didn't know who your special servicer was going to be, right? So there are definitely special servicers who are much tougher than others in their personality and how quickly they'll be to foreclose. The second is you didn't understand that there was a pooling and servicing agreement, which dictates how the loans are transferred to special servicing and what the fees that can be collected by the special servicer. And why the special servicer has an unfair advantage over you is because even in the event that they were to foreclose and sell and liquidate your property, the special servicer gets to keep all of their fees off the top of that liquidation. So they're really not, there's nothing you can do.
Doesn't matter. Yeah.
Your power is to pay off the loan or to sue them. Those are your two options.
Right.
or give back the keys. That's it. What we do is we try to give you what we want to do is when you have an issue with the special servicer. Now it could be administrative. It's like, hey, I'm in debt service coverage trap sweep and I can't get out of this, and we don't know where their math is coming from. We work on that. We work on, hey, we still have equity in our deal and we're afraid, and our loan's coming due for maturity, and we're afraid that the special servicer is just going to take it from us and liquidate it, which they can't. So what we do is we prepackage the workout in such a way that we take all the borrower's considerations and needs, put them in the memo. We understand the four walls of which we can work in. So we advise counsel and the borrowers on what that is. And so when it gets to the special servicer, it's easier to negotiate things off the table than put things on the table. So that way, and the specials like us and respect us enough to say, we know you have a deal here. We're going to prioritize this deal because we know that we're going to cut a deal and you guys are representing
Right.
that, but we could
You're
speak
dealing with professionals that can get it done.
can get it done. And there's professionals and very smart people that own real estate, but to understand CMBS, it's a 25 to 30-year process. And we don't call the top people that we know. I know all the top people in the group. I've worked with them. They're coworkers or friends. And the process is not set up to make it easy. So we work through the process and guide people through
Follow
because
the
we
rules.
understand it.
Yep.
Yeah, exactly. We go through, and then when there's an issue, we can rise.
Then you can call the boss if there's a
the
problem.
decision makers. Exactly.
Yeah. So walk us through what a typical situation, ideally a borrower comes to you 9 months before maturity. They're worried. That scenario, hey, we have plenty of equity, but we're coming up on maturity and, we don't know if we're going to be able to refi and,
Correct. Yeah.
walk us through, what your steps would be.
Yeah. So how I like to describe it is, when the borrower's calling us with the property and the information, I like to say we get a 360 view of the situation. You'll have me on the phone as more of the business guy and understanding and kind of representing the borrower and what they're facing, and because I understand how operations work on their side. We have Richard kind of representing the legal side and thinking about, okay, what are some of the implications. You have Tina, who's thinking about the special servicer side and what they're thinking about. You have your lawyer, who's thinking about all these different things. Mm-hmm. And I actually have somebody on my team. She does in new business for us, but was also a mortgage broker. So we can understand kind of what your alternatives are. So what we're trying to do is, how do we fix your problem? What's the best way? And we're often accused of bickering with each other. We're kind of like the old scientists, like we're pulling apart the engine, and you're like, well, you don't need that piece. But
sounds like my Jewish family getting together.
Yeah, exactly. But you know what I love, me and Fischel, Jews, but the thing is that when we're doing this, I know I can watch it, because if I'm the borrower, I love this. I want you to tell me what's going on and how our job is to help inform the borrower to minimize the risk so that they can make a decision, because that's how real estate works. You want to take all the things, the knowns, you want to know what your unknowns are, and then plan for the worst and hope for the best, right? And when you have a solid plan, on every one of my LinkedIn posts, I say be prepared and be proactive, because you have to go in. So when we're going into the servicer now, we may go in at the 9th month, and just to kind of socialize with the master on what's going on, give them a heads up, tell them what's going on, so they're communicating. Once we
have you ever been able to prevent a move to special servicing?
Yeah, we've been able. So you can actually there's it's called a non-transfer approval, and you can actually get approvals from the special without getting your loan transferred, which will avoid you a tremendous amount of fees and heartache.
Great. Yeah.
So by communicating in writing effectively, so that memo can be socialized amongst the master, the special, and the controlling class holder, and the backup documentation and the analytics which they need to see, which we know from our 25 to 30 years in this business of what a credit committee needs to see,
Mm-hmm.
you're going to get a much more informed answer on what direction they're going to take or not take. So we can then monitor where we go, because we're going to have to put the package in at least, we like to do it 120 days before the action. If you wait, it's just they're going to say, you know what, you didn't call me in time, and you obviously don't care about it, so we're just going to let it go.
Yeah, makes sense.
Or what if they sell your loan?
Well, and now I would assume the CMBS, there's some certain limitations though on their ability to sell, right? I mean,
I would say that they have the most flexibility of besides a private debt fund. I mean, they don't have a balance sheet. They don't have a balance at a bank. They have a regulator telling how much balance they could put on. In this case, they have REO departments. They know more.
Who's the decider? Is it the controlling class holder that
It
would
is, and so sometimes, just so it's a little bit of a kind of crazy, is that the special servicer can sometimes be also the controlling class holder. So
really?
LNR, K-Star, which is KKR's, Rialto, they also buy bonds. So they can be the controlling class holder at the same time. Sometimes you'll have like, for example, Midland, you'll have they'll be master and special servicer, and they'll be representing somebody else in the stack. But you're never going to figure out. It's very difficult to figure out who's the controlling class holder at the time. That's something
Interesting, and that's something TREP does not give you.
No, TREP, and in fact, that can move to be a little technical here. If you go into special servicing and the loan is large enough that affects the pool valuation because it got a decline in its value, even without any action, it could wipe out the existing bonds to say that we don't recognize the value of that building anymore, so of that loan. So that wipes it out, and you wipe out the controlling class holder. So there's a lot. I've got a lot. I mean, unfortunately, you're asking the plumber, like, what if I pull on that string? Right? Like, what if I just move that?
You could do like some kind of a daytime drama, like a soap opera.
No, it's like, oh my God. I mean, it's like a bowl of spaghetti in there. It's you're trying to figure
one group trying to screw each other over. I mean, it's the word. I guess it's the cutthroat world of investing.
It is. You know what? You went in there and you got a loan, and you got a great loan. And if your loan, CMBS is really set up. If you think about it, when you securitize things, you can securitize auto loans. You can securitize, obviously, residential loans. You can securitize cell phone tower loans. You can actually, when I started out there, securitize the royalty rates for James Brown. They securitize the right for Prince, because it's all you're doing is taking future cash flows and getting the present value. So now you're just dealing with people who really, at the end of the day, the CMBS works. If you make your loan payments and you pay your loan off, the bondholders are happy. Everybody's happy. It's a great product. I mean, it's when it's
way to get access to lower cost of capital,
or honestly, today it's a way to save yourself, because you're not going to be able to get the same loan at a bank.
True, and especially non-recourse. I mean,
correct.
Yeah,
correct.
Absolutely. So let's talk about where the most stress lies.
I'll say that office is definitely the headline news. And that's because really two things. One, you can't get your office back to stabilization. It's a very competitive market. San Francisco, Chicago, places where there's more supply than demand. Then there's situations where you actually have a very good office building, and you just lost a major tenant, and it's just timing. So now you have a timing issue. I'm at 75% occupancy. I've been at 100 the rest of my life. I now got to find a bridge loan, and that's going to be really expensive. Or I just need some time to make this work. The other one is really multifamily. I think multifamily is very overlevered. The CLO market is really wrought with a lot of over levered loans that are sitting there. I have no idea how they're performing.
How is that not blown up yet? I just don't get it.
I think it's because the current originator of that loan is just saying I don't want to blow it up and moving it off to other credit lines and doing other things to it. It's probably for another discussion because
Yeah, no,
it's
we
a
need
whole
to come
different.
back. We need to come back and unpack multifamily
Yeah,
at some
yeah.
point because
You're gonna need a big bottle of bourbon with this one.
that's right. We'll do we'll do that one over a drink for sure. I mean, look, the numbers don't lie. Also, in terms of just the new construction that had been coming online these last 2 years, 1,000,005 units a year or something
Yeah,
like that. And, I still am I'm still constantly argue with people over this housing shortage BS because the numbers are the numbers, and there's just as many housing units per capita as there were in 2008, 2009 when we had a ton of vacancies. The difference is that you've got especially the baby boomer class that's been third and fourth homes, or you've got investors believing the hype that there's some lack of housing. The reality is that some of those chickens are going to come home to roost, and I just
yeah,
don't see. I think there's a
yeah.
lot.
I don't. I. That's a whole another discussion. I will suggest that the dynamics in multifamilies are moving around. There's people that invested into lower classes, and they're seeing their population of tenants not moving in that they had. Just I think the economy is still TBD as to what happens. I think we have a very high amount of credit card debt and debt in itself with rates that are incredibly high. I
Hmm.
can't explain. I'm not an economist. I can only tell you I'm in men's shoes over here. Like that's all I do, right? I fix the CMBS deals. So I think that also you're finding property. I think that hotels, it's going to be a real case there. It's most hoteliers would tell you that COVID was their worst, was their 100-year flood, and that it was so bad. But if you look at the COVID extensions for hotels, the lender was using their product improvement plan money and their FF&E reserve to fund their debt service, which now means that it will become time to roost when you have to get a new franchise flag, and
That's right.
the franchise is going to say you need to find this money. So it's a very, that one's kind of on the cusp for me. I'm not sure, we're not
Yeah.
seeing as
No,
many,
that's a
but
good
I
point. I actually know I know a deal, a flagged hotel deal that's exactly that scenario. Guy can't. Guy has the money to reinvest in PIP, but can't let the bank won't let him. They're the lender in this case, private lender
right.
won't give him the time.
Right,
You know.
because when you're dealing with loan documents, you really have to think everything through. And honestly, we now have seen over the last 5 years so many loan documents and how they're written. I mean, I have a case right now where somebody's trying to pay off a loan. There's a penalty in the loan documents which is really doesn't make sense, but the lender's hanging their hat onto it, and now they're getting transferred into special servicing, which can incur even more fees. So this is a this is I warn people all the time, by calling the master servicer and thinking that they're your friend is probably the worst possible thing you can think, because they don't have decision. Second is, if you've got something verbally or somebody told you verbally, it's worth nothing, because this is a documented industry and you have to really understand that. And I think each there's so many unique cases, and so again, some are administrative. I'd say 30% of our business is administrative. A fee that shouldn't be charged, a debt service covered sweep, a release of funds, a you can't get access. I would say the majority of it is loan extensions. We've also been able to get discounted payoffs, and for people, I will tell everybody as loud as I can that discounted payoffs are unicorns right now. So if you think that you're gonna you're going to wait to see if you can get in and to get your arm wrestle a discounted payoff. The CMBS 2.0, which is after the Great Recession, they built in a lot of features into how they dispose of assets to make it that the B buyer, the special servicer, is not just the main beneficiary of all decisions. And so if they take back your property, they're probably more likely to put it onto an auction platform or through a brokerage, major brokerage house, and the capital markets will bid it up. So for you to get in there, your only way to really keep your loan is two things. One, to be the best shepherd that can take it through because you have a very good plan. And second, you have money to come to the table with. Now, I'm not suggesting that we pay down the loan. We keep it at the property level to keep it accretive to the property, but you have to have a plan and show the lender that you're the best one to take this through.
Well, I told you, by the way, that we could speak forever, and you are coming back. We're going to be doing another episode, but we'll take a few more minutes here. We're both busy. It's still a few more business days in the 2025 that we both have to deal with. Private credit, where does that play a role in the what you see in the future here? This private money that came.
Yeah, I mean, I think private credit is out there. It's abundant. I don't think it tapped fully because we haven't seen enough trades in the marketplace yet. I think where it's coming up now, you really have to make a decision whether it's a loan to own in the private credit world.
That's right.
Now, if you could take advantage of it, like I always tell people, for people that want to acquire loans through CMBS but don't want to wait for the auction, one way is to find the deals that are broken, we can come in and work with the current owner, and then you invest as preferred equity in the deal. And then we try to get you as a recognized substitute guarantor, and then you can. But otherwise, private. I haven't really tracked private capital. I mean, we need the pref to come into some of these deals, but really, if you're the borrower, if you're the owner of that property, and you have to put another dime in, you're going to want to make sure that any new money that you put in is worthwhile for you. That the lender is going to modify your loan in such a way that it will give you the ability to be accretive to get through this cycle, and B, that any new money can get some sort of a preferred return.
Yeah. By the way, don't forget me when it comes to that kind of thing.
I won't. I can't. Everybody and their brother.
In case we get off this call and don't talk for a few weeks, don't forget about me.
Yeah, I really.
I'll look at those things.
Yeah. No, I know. So we're key. We're just my business is to unlock this.
Right. And you're part of this group of old school folks that have been around the business. I keep saying, guys like you and I and gals like your team and our team, they do not exist.
No.
Special asset groups at banks disappeared, and some of the major ones kept on. I was talking to a banker a couple months ago, and she said, I can't get my CEO to let me hire one more SAG person. And even if I did, I couldn't find anyone because there hasn't been an industry.
Yeah. There's a problem with that there's definitely a seniority gap in the servicing, and we find our success is because the asset managers can talk to us, ask us questions. We're laying it out for them. We can kind of look in,
like mentoring them in a way.
Yeah, kind of. But that's okay. I mean, if we're getting the deal done, honestly, I'm not going to waste our percentage of closings are I want to say just below 90%. Why? Because we pick and choose. We pick and choose our clients, and I'm not throwing noodles against the wall. We're interviewing you while you're interviewing us. So, in the ones that are ready to go, we're ready. You get all of us on the deal.
Yeah. I was just thinking about your multifamily comment tonight. I 100% agree. And even when you look at the negative leverage conversation we were having, it never made sense to me that low rise 200 unit C complexes in the Midwest would trade at a 4.5 cap.
Correct.
It just never made sense.
But you know what I've learned in life is it's capital chasing yield. And when capital chases yield, it doesn't think about anything. That's why most of the buyers that I know in this marketplace are not buying a lot of product, because everything's getting bid up too high by the credit buyers. And the smart people are just, unless you're lucky, you're not finding any great deals now. Now, you want to ask me about 26? I think
Yes, let's
26.
get into it because we got a few minutes left.
I
I've
think
heard you talk
26.
about $1 trillion debt maturity wall in the
Yeah.
next year and everything. And you said something about the early innings, like we're
Yeah,
just getting
no,
on
this
the
is it.
field.
This is it. The bar, everything. I tell everybody the same thing. Everything's on the table with your loan. Everything, every single thing, and you better be prepared for everything, including your loan being sold. You better be prepared for a foreclose. You better be prepared for a modification, and you have to start doing everything. And I believe that if we start to come to a place where the equity that's private capital that's out there starts to say, let's buy. And if we see a major bank dump, this could, and the government's not going to let that happen, right? They're not going to let people dump. But I will say, if there's starting to be a velocity of borrowers in that market, then they're going to start to liquidate and foreclose, because there's no reason why they're hanging on to your 4% coupon loan when it's getting marked to market in the bank, and the bank can put on a 6% coupon for a better loan for a better borrower. So there's nothing, there's no safe haven here. You need your team to get to saddle up. And I think 26 is the year. By the way, this is not just me predicting. I'm watching special servicers and masters are getting more aggressive. They're looking at every loan now like as if they just bought it. They're looking and saying, hey, by the way, 3 years ago, you should have been in a cash flow sweep because there was some sort of a covenant trigger, maybe the tenant rating or somebody went dark. You need to send us that money right now, or else you're in default. So
the push is coming.
the push is coming. Be proactive, be prepared. I can't say any louder. Follow me on LinkedIn. It's all on Brighton Capital Advisors. Go to our website. We post other podcasts such as yourself. We post in insight articles. We put on case studies of what we're doing. I'm not afraid. We don't have one worse special service than the other. It's on how you approach it. We deal with institutional clients and we deal with local people. We look at this as holistically as we can.
Very cool. Right, Michael, I wish we could talk forever. This has been a great hour.
Can't believe it's been an hour already.
I know. Can you believe it? We blinked and it was for 50 minutes, 55 minutes.
Wow.
It was really great being with you. Thanks for joining me. Let's do this again.
Yes.
We are definitely doing a part 2, and we're going to get you in for regular updates.
Love it. My job now is to go and spread what we do so that we can help
The
people.
gospel
So if you need us, you know what? Honestly, if you want to listen, I'm not doing this for my health. I'm doing this for, we can actually help you. We're built to do this. And if you need us, just contact us, or there's an inquiry page on our website.
It's also about, this is why I started the Debt Doctor. It's about getting the conversation going now, because when the wall hits or the shoe drops, we're there and we were already prepared for it.
Correct.
That's great.
I appreciate you taking the time with me. It's been great.
Thanks, Michael. Thanks for joining the Debt Doctor.
You got it.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.